if I told you that you could build your own trading desk covering 676 assets, real assets, running 5 independent strategies, all with a team of AI analysts optimizing parameters overnight, and all for less than the cost of a Bloomberg terminal subscription? I'm not talking about some get-rich-quick scheme again. I'm talking about a systematic approach to trading that combines quantitative signals, market sentiment, prediction markets, 34,000 correlated pairs, and an actual fleet of AI agents that analyze, recommend, and track every trade. I built this in 8 days. It's running right now. It actually scored enterprise-level results on JP Morgan's analysis framework, which says it's capable of managing over $500 million in assets. And today, I'm going to show you exactly how it works. You're listening to The Builder's Frequency. I'm Joshua Levy, test engineer by day, founder by night. This is where we talk about building things that matter. Businesses, systems, and a life worth passing down. Now, before we go any further, I need to be crystal clear about something. I'm not a financial advisor. Nothing in this episode or anywhere on this podcast constitutes financial advice. Everything I'm sharing today is experimental. I'm building the system in public, testing it with my own time and money, and documenting the journey, educational content about how I'm approaching a personal project. Do not trade based on anything I say. Do your own research. Consult a licensed financial professional before making any investment decisions. Past performance does not guarantee future results. You can lose money and possibly all of it, so be careful. I'm sharing this because I think the process is interesting, not because I think you should copy me. Clear? Okay, let's go. Before I show you the system, I need to tell you why I'm building this, because this isn't a hobby project. This is survival. Here's the thing. I'm a test engineer at a major tech company, and I've been doing this for over a decade. And while I'm good at it, I'm not naive about what's coming. AI is going to replace my job. Not might, will. It's not a question of if, it's a question of when. And I've done the math. I give myself roughly 5 to 10 years before my role as a full-time test engineer becomes obsolete, maybe less. Look at what's happening already. AI can write code, can review code, can generate test cases, find bugs, and automate entire QA pipelines. Right now in 2026, these tools still need human oversight, but that gap is closing fast. Every month, the models get better. Every month, the oversight required gets smaller. The same skills that make me valuable today, pattern recognition, systematic thinking, debugging complex systems, those are exactly the skills that AI is getting good at. So I asked myself a hard question. If I have 5 to 10 years left in this career, what do I do with that time? I could bury my head in the sand, pretend like it's not happening, and ride the wave until it crashes. Or I could use this window while I still have stable income to build something that replaces that income before I'm forced to. And to give you a sense of what that building actually looks like, the system I'm about to show you went through 13 versions in 8 days. Each one a step change. Version 7 added prediction market data. Version 10 expanded from 9 assets to 25. And version 13, the Universe Edition, 676 tickers with 5 independent strategies and an overnight optimizer. 8 days, 13 versions. That's what building with urgency looks like. Now, the conventional wisdom would say, just invest, build a nest egg. Invest in the classic 60-40 portfolio with 60% in stocks and 40% in bonds. Buy and hold. Don't try to time the markets. Set it and forget it. But here's the problem. I don't have time for buy and hold. Now, I stumbled upon Chris Vermeulen's work a few years ago. Chris is a quantitative researcher who completely changed how I think about investing. His critique of the traditional 60-40 approach is devastating. And it's especially devastating for someone on a compressed timeline like me. Let me explain. A traditional 60-40 investor sits through drawdowns of 30 to 50%. That's not a minor dip, and that's watching half of your portfolio just disappear. And the kicker is it can take years to recover. Look at the S&P 500 from the year 2000 to 2013. If you bought at the dot-com peak in March of 2000, you watched your portfolio drop 50% by 2002. Then let it slowly recover. And you finally broke even late in 2007. Great, right? Well, except 2 months later, the financial crisis hit and you lost another 50%. You didn't permanently recover your 2000 investment until 2013. That's 13 years of stress, of no movement, 2 massive crashes. And if you needed that money in between for a house or retirement or for even an emergency, You were selling at a loss. Now, think about my situation. If, if I have 5 to 10 years before AI potentially eliminates my job, if a crash hits in year 3 and I'm down 50% and it takes 7 years to recover, I'm done. I don't have 13 years of runway. I don't have the luxury of waiting out a lost decade. Buy and hold assumes that you have infinite amount of time and infinite emotional resilience. And I am honest with myself when I say I have neither. The second issue, the 60-40 split offers a false sense of security. The whole premise is that the stock and bonds are negatively correlated. When one goes down, the other one goes up. Diversification protects you in that scenario. Well, except in 2022, where both stocks and bonds fell simultaneously. The promised diversification failed here. In high inflation or rising rate environments, that historical negative correlation breaks down completely. So you're holding two losing assets, telling yourself you're diversified. That's not a strategy. That's just hope. And third, by design, a 60-40 portfolio forces you to keep owning losing assets. Chris Vermeulen puts it bluntly, wealth builds faster when it's not constantly being repaired from losses. If you lose 50%, you need 100% gain just to get back to that even. That's not building wealth, that's running on a treadmill. So let me be specific about what I actually need. To sustain my family's current lifestyle, mortgage, kids, savings, and the basics, I need approximately $200K per year in income. That's my target. That's what I need this system to eventually generate. I'm starting with $100K in a brokerage account. That's money I've saved over years. And it's not nothing, but it's not a hedge fund capital either. If I need $200K per year from a $100K account, it's a 200% annual return, and that's not realistic. That's just gambling. But that's not the plan. The plan has 3 phases. Phase 1 is grow the capital. For the next 5 to 10 years, while I still have my engineering salary, I'm not trying to live off trading income. I'm trying to grow the account. Every dollar I save goes into the brokerage account. Every gain compounds, and if I can average 15 to 20% annual returns and add 30 to 40K per year from my salary, in 7 to 8 years, that 100K becomes 500 to 800. Now, phase 2, transition to income. Once the account is large enough, the math changes. A 25 to 30% return on 700K is over 200K per year. Now, that's still aggressive, but it's in the realm of what systematic traders achieve. Phase 3, scale and diversify. Beyond that, you reduce risk, target 15% returns on a larger basis. The goal isn't to get rich quick. The goal is reliable income before I'm forced to find out if I can. So what does Chris Vermeulen advocate instead of the 60-40? He calls it asset revesting, a tactical approach focused on capital protection and trend following. Here's the core insight that changed everything for me. You do not need to predict the future. You just need to follow the regime. Instead of a fixed allocation, you rotate capital between stocks, bonds, commodities, or cash, depending on which asset class is currently in a strong uptrend. If nothing meets your criteria for a healthy trend, you hold cash. Vermeulen says he may hold 100% of cash for up to 40% of the year if no assets are trending well. That sounds crazy to a traditional investor, but you're missing gains, maybe, but you're also missing losses. And not losing is the first rule of compounding. The strategy ignores news, earnings, and hope. It relies strictly on price mechanics. Technical modeling of price, volume, and cycles decide when to move into or out of a position. Is the market in a bull regime? Buy stocks. Bear regime? Rotate to bonds or gold. Sideways? Stay in cash and wait for clarity. That's asset revesting, not day trading, not predicting every tick, just reading the environment and positioning accordingly. The problem is, doing this manually is exhausting. You'd have to track dozens of indicators across multiple asset classes every single day. So I asked a simple question. What if I could automate this? What if I could build a system that does the analysis for me? That question became the MRE, the multi-regime engine. So that's why I built it. That's why I'm sharing this with you, because I'm betting my family's financial future on this system working. If that sounds dramatic, good. It should. This isn't a game to me. I publish weekly updates in a newsletter called Today's Plays. And every day I document what it says. You can track the wins, losses, and everything in between. Links in the show notes. It's free. Now let me explain how the system actually works. Before we go any further, let me explain what a regime signal actually is, because this is the foundation of everything. A regime is the underlying state of the market, not the daily noise, the trend. There are 3 primary regimes, which is basically higher highs and higher lows over an extended period. Momentum is positive. The trend is up. This is where you want to be aggressive with risk assets. Bear regime, lower highs and lower lows. The momentum is negative. The trend is down. This is where you want to be defensive, cash, bonds, or inverse positions. A sideways regime, no clear direction. The market is consolidating, waiting for a catalyst. This is where you want to wait for a breakout before committing. Here's why regime signals are so effective. They filter out the noise. Every day, the financial news tells you something on the market is either crashing or mooning. It's designed to trigger emotion, but when you zoom out and you look at the regime, you see the actual trend. Think of it like the tide of the ocean versus the waves. The waves crash in every direction, chaotic, loud, hard to predict. But the tide tells you whether the water is rising or falling. You can't fight the tide. Daily price action is waves. The regime is the tide. Our system now calculates regime signals for 676 individual tickers. That's the full S&P 500, the NASDAQ 100, the Dow 30, and 159 ETFs covering every corner of the market. Each gets its own regime classification. For example, right now, gold is in a bull regime. It's been bullish for over 100 days, but small cap stocks are in a bear regime. If you're blindly buying and holding everything, you'd be holding losers alongside winners. Regime awareness lets you rotate into what's working. And so how does the MRE engine actually calculate all this? Let me walk you through the components. And fair warning, this section has gotten a lot bigger since I first built this thing. When I started, the MRE had only one strategy, just one, the fear and greed contrarian. It watched the CNN index when people panicked and said buy. Simple and elegant. But here's the problem. The market isn't always scared or greedy. Sometimes it's just neutral. And during neutral markets, the fear and greed strategy produces exactly 0 signals. I know this because I watched it happen. Days would go by and there would be nothing, no signals. The system was sitting there fully built, staring at the market, saying, I have no opinion. And it made sense because we're in a sideways market currently. That's when I realized you can't run a trading desk on a single signal. You need a portfolio of strategies the same way you need a portfolio of assets to diversify your signals. So now the MRE runs on 5 independent strategies. Let me walk you through each one. We pull the CNN Fear and Greed Index daily. This is a composite of 7 market indicators of volatility, market momentum, stock price strength, put-call ratios, junk bond demands, market breadth, and safe haven demand. When the index is below 30, extreme fear. That's historically been a great buying opportunity. When it's above 70, it's extreme greed. That's when you get cautious. This is the classic contrarian play. It still works. It just can't be the only play. This strategy buys dips within established bull regimes. If an asset has been in a confirmed bull regime and pulls back 2 to 5%, that's not a trend break. That's a discount. The regime confirmation strategy triggers on those dips. Think of it as a trust the trend strategy. The macro environment says up, the price just got cheaper, so we just buy. RSI, the relative strength index, is a classical technical indicator. When RSI drops below 30, the asset is oversold. Historically, that's a mean reversion setup. Price has been pushed too far, too fast, and it tends to bounce. This strategy catches those bounces. It's purely technical. It doesn't care about the fear and greed index. It doesn't care about the news, just the math of the price momentum. Similar idea, but different math. Bollinger Bands measure how far price is deviated from its moving average. When price touches or breaks below the lower band, it's statistically stretched. This strategy buys the snapback. This is a fun one. The system analyzed all 676 tickers against each other and discovered 34,760 correlated pairs. Of those, 2,654 pairs have a correlation above 0.95, meaning that they move together on more than 95% of the time. When 2 highly correlated assets diverge, one drops while the other holds, that divergence tends to close. This strategy trades the convergence. It's like pairs trading at a hedge fund, except my AI found the pairs for me overnight. Now, that's 5 strategies, each one independent, each one looking at the market through a different lens. When multiple strategies agree on the same asset at the same time, well, that's when we pay attention. Now let me talk about what feeds these strategies because the data layer has expanded massively. We still use the core signals, CNN fear and greed, regime detection, regime detection with exponential moving averages, Fibonacci retracements and projections, and prediction market data from Kalshi and Polymarket. VIX data. The VIX tells you how scared the options market is. We use it for crash mode detection. When the VIX spikes above a certain threshold, the system shifts into a capital preservation mode. Market breadth. Two flavors. First, the RSP versus SPY ratio with 23 years of history. RSP is the equal weight S&P 500, and SPY is the cap weight. When RSP outperforms SPY, breadth is healthy. Most stocks are participating. When SPY leads, the rally is narrow and fragile. Second, internal breadth. We calculate what percentage of our 676 tickers are trading above their 50-day moving average. Right now, 465 out of 675. That's 69% approximately. That tells you that the market is generally healthy, but not euphoric. If that number drops below 40, something's wrong. Now, sector rotation. We track 10 different sector ETFs: technology, healthcare, energy, financials, the works. Where money is flung between sectors tells you what regime the market is actually in, regardless of what the headlines say. 34,760 correlated pairs, as I mentioned. The system maps the entire correlation matrix of our universe. This isn't just for the pair strategy. It also tells us when correlations are breaking down, which is often early warnings of a regime change. This is where it gets technical, but stay with me because this is powerful. Fibonacci retracements use 2 points, swing high and swing low, to identify potential support and resistance levels during a pullback. Key levels are 38.2%, 50%, and 61.8%. If we're in a bull regime and the price pulls back to the 38.2 retracement, that's often a buying opportunity. Fibonacci projections. Now they go way further. They use 3 points, the swing low, swing high, and pullback low, to predict where the price might go after the pullback is done. The key projection levels there are 127.2%, 161.8%, and 200%, which is the 100% measured move. So in a bull regime, we're looking for pullbacks to the retracement levels for entry and projecting extensions for profit targets. It's math, it's not magic. Now, here's something most retail systems don't include. We incorporate data from prediction markets. Kalshi and Polymarket are platforms where people bet real money on future outcomes, economic indicators, Fed decisions, political events. Unlike surveys or pundit opinions, prediction markets have skin in the game. We pull their data on key questions. Will the Fed raise rates? Will inflation surprise to the upside? Will there be a recession in 2026? This gives us a probabilistic view of the macro environment that complements our technical analysis. If the prediction markets are pricing a 70% chance of rate hikes, but our regime signals are still bullish, that's a yellow flag. Every signal we generate comes with a confidence score and expected accuracy. And here's how we got those numbers. I'm actually using Claudebot, my AI copilot. It runs cron jobs every 5 minutes for an entire week straight. The system would test a hypothesis, measure the results, identify weaknesses, and improve itself, then test again. Hundreds of iterations completely automated. By the end, we had expected accuracy numbers for each asset class based on historical performance. When the regime signal for gold is bullish with these specific parameters, it's been correct 65% of the time over the past decade. That's not a guess, that's empirical. And here's now where I have to pause to talk about validation, because anyone can build a trading system. The question is, does it actually work? Well, I ran ours through JP Morgan's cross-asset strategy and quantitative research framework. It's the same institutional grade analysis they use to evaluate hedge fund strategies. And the results were honestly better than I expected. Let me give you specific numbers. We ran over 4,100 back tests across 27 unique configurations. That's not cherry picking one good result. That's stress testing across market conditions. The overall accuracy came in at 60.09%. But here's the important part. Buy signal accuracy was 65.65%, with a p-value of essentially 0. That means the result is statistically significant at the 1% level. This isn't random chance. The effect size, Cohen's d, was 0.65, which JP Morgan classifies as medium. The Sharpe ratio, which measures return per unit of risk, averaged 1.13. Anything above 1.0 is considered good. 45% of our configurations scored above 1.0. and 25% scored above 2. This is the part, though, that blew my mind. JP Morgan's framework assessed our system's capacity, i.e., how much money could it manage before market impact became a problem. The verdict? $100 million to $500 million deployable, with tier one liquidity in the broad market, financials, bonds, and technology. Their recommended initial allocation was $10 to $50 million, prioritizing market index ETFs. Now, I'm not managing $50 million, but the system's built to that scale. That's not a toy strategy. And JP Morgan's overall assessment, approved for deployment. Now, am I managing $500 million? No. But knowing that the system passed institutional grade scrutiny matters. And since that validation, the system has gotten dramatically more sophisticated. 5 strategies instead of 1, 676 assets instead of 15. An overnight optimizer running hundreds of thousands of backtests. The JP Morgan framework validated the foundation, and we've built a skyscraper on top of it. Here's the thing that most people get wrong about quantitative trading. Having data isn't the same thing as having a decision. I've got signals for 676 different tickers, 5 strategies per ticker. Do I trade all of them? Obviously not. The raw signals aren't actionable, they're inputs. So I built a second layer, today's plays. Now, today's plays synthesizes the raw signals into 4 categories. Buy. The signal is strong. We're in a bull market with 70% confidence. Momentum is positive and the price is within 3% of our Fibonacci entry zone. Or the fear index is below 30 and we're buying on the fear. Or the RSI is oversold. Or Bollinger Bands are stretched. Or a correlated pair has diverged. And ideally, multiple of these agree. Watch. This isn't a sideways regime. This means it could break either direction and we're watching for a breakout. Hold. This is your bull regime, but the price has run too far from the entry zone. Don't chase it. Wait for a pullback. Wait. This is in a bear regime. Capital preservation mode. Cash is position. Let me give you an example of how the system actually plays out. BLD, the gold ETF, has been one of our strongest positions. Gold's regime has been bullish over 117 days, confidence at 85%. When Trump announced his Fed chair pick and gold sold off 5%, the news felt bad. But here's what the system saw. The regime was still intact. Momentum was still 9.89% over 20 days. The sell-off hadn't broken the trend. It just had created a discount. Price had pulled back exactly to the 382 Fibonacci retracement level, the first major entry zone in a bull trend. The prediction markets confirmed it, still pricing gold favorably outcomes, despite the headline noise. The news said sell. The regime said buy the dip. Multiple strategies agreed. We followed the regime. GLD is now one of the 8 positions in the paper portfolio. Here's something I learned the hard way. A single strategy saying buy is interesting. 2 strategies saying buy is worth attention. 3 or more? Well, that's when you act. The system now tracks how many of the 5 strategies agree on each signal. We call this the confirmation level. 1 of 5, 2 of 5, up to 5 of 5. The overnight optimizer actually tests which confirmation threshold works best for each asset in each regime. Some assets trade better on single signals. Others need 3 strategies to agree before the edge appears. The system knows which one's which. One more critical piece, position sizing. I don't bet the same amount on every trade. Higher confidence equals larger positions. At 50% confidence, I allocate about 8% of the portfolio. At 90% confidence, I go up to 25%. This is the Kelly criterion logic applied to a constrained portfolio. Every buy signal also comes with a stop loss based on Fibonacci retracements and profit targets based on projections. No emotion, just math. This is exactly what you get in the Today's Plays newsletter. Every week I publish the system's performance. What showed buy, what showed hold, what showed watch, and its results after that week. And here's the key. I also track performance. Every week I will publish the system's performance. Did last week's buy signals hit their targets? Did the stops get triggered? What's the running accuracy? It's a real-time window into whether this system is actually working. I'm not hiding the losses. I'm documenting everything because that's the only way to know if this is real or if I'm fooling myself. Again, this is all experimental, so I'm not telling you to trade these signals. I'm showing you my process. But if you want to follow along and see how it plays out, the link's in the show notes. Now here, in my opinion, is where it gets really interesting. Having a trading system is one thing, but operating it is another. I work a full-time job. I have 2 kids, and I can't be staring at charts all day. So I built something better, a fleet of AI agents that manage the system for me. 4 agents, each with a specific job. This agent runs every 5 minutes during the market hours, 6:30 a.m. to 2 p.m. Pacific. Its job is simple. Refresh all the prices, check if any pending orders have been triggered, and keep the dashboard current. It's the grunt worker. It doesn't think, it just fetches data and pushes updates. This is the smart one now. Before I execute any trade, I ask the advisor for analysis. The advisor takes the quantitative signal from today's plays and adds qualitative context. It searches for recent news, chart patterns like double tops, head and shoulders, and wedges, and it checks prediction markets from Kalshi and Poly markets for prediction data. And it also checks historical precedent. And here's the key. The advisor can override the system. If today's plays says buy, but the advisor sees a bearish divergence forming, or the prediction markets just shifted against the trade, it'll say, system shows buy, but I want to recommend wait. And here's why. It's the human judgment layer implemented in AI. Every day after market close, the analyst reviews performance. It tracks which signals were accurate and which failed and why. It maintains a running accuracy score for each asset class, and it identifies patterns. Maybe healthcare signals have been underperforming or gold signals work better in fear regimes. The output goes to a shared document that all agents can read. Strategy issues. If something is broken, the analyst finds it. Okay, this is the one that changed everything. The original optimizer ran weekly and made incremental adjustments. That was V7. The V13 optimizer is a 5-phase quantitative pipeline that I set running before bed and wake up to calibrated signals. Every one of these agents is running right now on my Mac Mini, using Claude as the underlying model. They communicate through shared files. They have their own memory, and they learn. The total cost is about $50 a month in API calls. That's less than most trading platforms' subscriptions. But lastly, I'm a visual person, and I need to see what's happening. So I built a dashboard, and that shows everything in one place. Market sentiment, today's plays, universe table, paper portfolio where I'm testing the strategy with fake money, performance tracking, and one-click trading. Everything persists. Everything I trade is logged and every decision is traceable. When the paper trades prove out over meaningful sample months, not weeks, I flip a switch and it's real money. Now, to get into the faith aspect of all this, you might be wondering, what does this have to do with faith? And bear with me. There's a proverb that says, the plans of the diligent lead surely to abundance, but everyone who is hasty comes only to poverty. Notice what it doesn't mention. It doesn't mention the plans of the talented. It doesn't mention the plans of the lucky. It says the diligent. Diligence is showing up every day. It's not chasing the hot stock tip. It's following a process. It's running 300,000 back tests overnight because you want to get it right. That's what the system is about. It's not getting rich quick. It's not gambling, but diligently applying wisdom to decisions and removing emotion and trusting the process. 13 versions in 8 days. Every version better than the last. Each bug found and fixed. Not because I'm talented, but because I kept showing up and working on it. The agents run whether I'm watching or not. The system compounds whether I check it or not. The optimizer calibrates everything whether I'm watching or not. That's the goal. Build once, let it work. Focus on what matters. Family, craft, and calling. Now, let's bring it home. 7 things to remember from today. If you want to follow this experiment in real time, subscribe to today's plays. Every week, you'll see what showed buy, what's in hold mode, and what the confidence levels were, what the Fibonacci entry zones and targets look like, and which strategies were agreeing. And more importantly, you'll see the results. Did they work? Did the signals work? What's the running accuracy? Am I beating buy and hold, or am I fooling myself? This is a live experiment. I'm not cherry picking wins. I'm showing you everything, the good and the bad. If the system is going to replace my income in 5 to 10 years, I need to know if it actually works. And now you can follow along. Link is in the show notes. It is free. And one more time for the lawyers, I am not a financial advisor. This is not financial advice. Everything that I'm sharing is experimental and educational. Do not trade based on my signals. Do your own research. Past performance does not guarantee anything. So you can lose money and you can lose a lot of it. But if you're curious about the process, the architecture, the code, the agent configurations, the 5 strategies, the overnight optimizer, that's all in the newsletter as well. Subscribe and I'll send it to you. And if you're building something similar, trading, research, operations, I'd love to hear about it. Reply to the newsletter or find me on X. Let's compare notes. That's the Builder's Frequency. I'm Joshua Levy. Keep building and I'll see you next week.